Have you ever stopped to think about what you actually owe? Maybe, that $10 you borrowed from a friend.
Yeah.
Or your credit card bill, rent. No, just scale that way up. Think about a huge company, right? What do they owe? And maybe more importantly, when do they have to pay it back? Understanding these obligations, especially the short-term ones, it's not just accountant talk. It's actually vital, like really vital for understanding a company's financial health. It's like checking its pulse. So today we're doing a deep dive. We're going into a really fundamental part of financial accounting, current liabilities. And specifically, we're zeroing in on what are called payables. Our goal here, our mission if you like, is to unpack what these are, the different types, what they mean, so that you, listening, can get a quick handle on this concept and really understand a company's short-term commitments. Think of it like getting a decoder ring for the balance sheet. Okay, but before we dive deeper, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, the explanations we'll be discussing, it's all derived from the accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support to help reinforce what we talk about today. And a special thanks to Professor Farhat for providing this great material for us. All right, let's get into it then. Liabilities. So what is a liability in accounting terms? At its core, it's a financial obligation, right? It comes from something that happened in the past. And it means the company has to give up something valuable in the future, usually cash, but could be goods or services. It's not just a maybe, it's a commitment they kind of can't avoid.
Exactly. And that distinction is really important. Is it a real liability or just, a plan for future spending? For something to officially count as a liability on the books, it has to meet 3 specific conditions. First, there's a probable future sacrifice of economic benefits, so it's highly likely they'll have to pay up or deliver something. Second, it comes from a present obligation, meaning it's unavoidable now, the company is on the hook. And third, this obligation is the result of a past event or transaction. Something already happened to create it. Think about it like this, for yourself maybe. If you're just planning to buy a new TV next month, that's a future expense, sure, but it's not a liability yet. But if you went out yesterday, bought the TV on store credit, well, even if the first payment isn't due for 30 days, you have a present obligation right now because of that past event, buying the TV. That's a liability. These conditions really separate the definite debts from the maybes.
Okay, that makes perfect sense. That's the foundation. So building on that, let's zoom in on current liabilities. What makes them current?
Good question. Current basically means short term. These are the obligations a company expects to settle pretty soon, usually within 1 year. Or sometimes within their normal operating cycle, if that happens to be longer than a year, which is less common but possible for some industries.
Right, the operating cycle being the time it takes to turn inventory into cash.
Exactly. And the split current versus long-term, it's super important.
Why is that distinction so critical?
It tells you about liquidity, a company's ability to pay its bills as they come due in the near future. If you see a ton of current liabilities piling up, but not much cash or things easily turned into cash, well, that could be a warning sign, a potential red flag.
Got it. Liquidity is key. So today we're focusing on the payables under this current liability umbrella. You mentioned a few common types we'll cover.
Yes, we'll get into the main ones, things like accounts payable, notes payable, sales taxes payable, income taxes payable. And we'll also touch on things like salaries payable, unearned revenue, and that current part of long-term debt.
Okay, great. Sounds like a good roadmap. So we've set the stage. We know what liabilities are, what makes them current. Let's start peeling back the layers on these specific types of payables. This is where we see it in action, right?
Yeah.
Let's kick off with accounts payable. Sounds pretty fundamental.
It really is. Accounts payable, or AP, is probably the most common type you'll see. It's basically the money a company owes to its suppliers for goods or services bought on credit, on an open account. You get the stuff now, pay in 30 or 60 days, typically.
So just the day-to-day bills for running the business.
Pretty much. And recording them is usually straightforward. It's just the amount on the invoice. Though sometimes there are nuances, like purchase discounts for paying early. But the starting point is the invoice amount. And, looking at a company's AP can actually tell you a bit about how they manage their cash. Are they paying suppliers quickly? Or are they stretching payments out? It can hint at their relationships and their cash flow situation.
Interesting points. More than just a number, then?
Definitely. So let's take an example from the Farhat lectures material. Say, Target buys $800,000 worth of merchandise from Clorox on credit. Terms are 210, net 30, meaning a 2% discount if they pay in 10 days, otherwise the full amount in 30. When Target receives the goods, they'd record it like this. Inventory goes up by $800,000, and accounts payable also goes up by $800,000. They now owe Clorox that amount.
Makes sense. Asset up, liability up.
Precisely. And it's really crucial for companies to record that AP liability as soon as they legally own the goods or receive the service. Especially near the end of an accounting period, you need careful cutoff procedures to match the liability to the right period.
Okay, so that's accounts payable, the regular operational IOUs.
Yeah.
Now, what about notes payable? You said these are a bit more formal.
That's a good way to describe it. Notes payable involve a formal written promise, a promissory note. It specifies the amount to be paid, the date it's due, and often interest details.
So more like a formal loan document.
Kind of, yeah. And they can be either interest-bearing, where there's a stated interest rate, or what's called zero interest-bearing, which is a bit different. We'll get to that. And just like other liabilities, we classify them as short-term if due within a year, or long-term if due later.
Let's break down an interest-bearing one first. Can you walk us through an example?
Sure. Let's use the Eat Street example from the material. Imagine Eat Street borrows $100,000 from Wells Fargo. They issue a 4-month note on March 1st, and it has a 6% annual interest rate.
Okay, so March 1st, they get the cash. What's the entry?
Simple enough. Cash goes up by $100,000, and notes payable goes up by $100,000.
Debit cash, credit notes payable. Got it.
Right. Now, interest starts accruing. Let's say Eat Street prepares financial statements semi-annually, so they need an adjusting entry at June 30th. By June 30th, 4 months have passed. So we need to calculate the interest expense for those 4 months. That's $100,000 principal times 6% annual rate times 412 of a year.
Okay, 100,000 times 0.06 is 6,000. Times 4 divided by 12. That's $2,000.
Exactly. So at June 30th, they record an adjusting entry. Debit interest expense for $2,000 and credit interest payable for $2,000.
Ah, payable because they haven't paid it yet. Just recognize the expense.
Correct. Then, on July 1st, the note matures. They have to pay it back plus the interest. So the entry would be debit notes payable for $100,000 to clear the debt, debit interest payable for $2,000 to clear that liability, and credit cash for the total amount, $102,000.
Okay, that seems logical. Expense accrues, then it's paid with the principal. Now, you mentioned these zero interest-bearing notes. That sounds counterintuitive. How can a loan have zero interest?
Yeah, the name is a bit misleading. It's not truly zero interest. The interest is implicit. It's just not stated separately.
Implicit. How does that work?
Basically, the borrower receives less cash up front than the actual face value of the note they promised to pay back. The difference is the interest.
Ah, okay, so it's embedded in the numbers.
Exactly. Let's use Eat Street again. Suppose they issue a $102,000 4-month zero interest-bearing note on March 1st. But Wells Fargo only gives them $100,000 in cash today.
So they get $100 but promise to pay back $102K in 4 months.
Precisely. That $2,000 difference is the interest charge for the 4 months.
Okay, so how is that recorded on March 1st?
It's a bit different. Cash goes up by $100,000 what they received. Notes payable is credited for the full face value, $102,000. And the difference, that $2,000, is recorded as a debit to an account called Discount on Notes Payable.
Discount on notes payable. What kind of account is that?
It's a contra liability account.
Contra liability, so it reduces the liability.
That's right. It sits on the balance sheet directly underneath the notes payable, reducing its carrying amount. So right at the start, the balance sheet would show notes payable, $102,000, less discount on notes payable, $2,000, for a net carrying amount of $100,000, which is the cash they actually got.
Okay, I see. And that $2,000 discount, does it just sit there?
No, that discount represents the total interest cost. It gets amortized or spread out as interest expense over the life of the note, in this case, over the 4 months.
So it gradually turns into expense,
Yeah.
matching the interest cost to the period it relates to.
Exactly. It ensures the interest cost is recognized over time, even though it wasn't explicitly stated as a rate. It reflects the true economics of the loan.
Fascinating. It really shows how accounting tries to capture the substance over just the form. All right, moving on. Let's talk sales taxes payable. We all deal with sales tax as consumers. How does it work for the business collecting it?
Right. So when a retailer sells something in a place with sales tax, they collect that tax from the customer. But that money isn't theirs. They're essentially acting as a collection agent for the government, the state or local tax authority.
So it's not revenue for them.
Absolutely not. It's a liability. They collect it, hold on to it temporarily, and then they have an obligation to remit it to pay it over to the government.
Makes sense. They're just a middleman.
Pretty much. So let's say a store sells $3,000 worth of goods and the sales tax rate is 4%. The customer pays $3,000 plus 4% of that, which is $120. So the total cash collected is $3,120.
Okay.
The store records debit cash for $3,120, credit sales revenue for $3,000, and credit sales taxes payable for $120. That $120 sits as a current liability until they pay the tax authority.
What if they say ring up the total, including tax, as revenue initially?
Sometimes that happens, especially with simpler cash register systems. If they recorded the whole $3,120 as sales revenue initially, they'd need an adjusting entry later to back out the tax portion. They'd debit sales revenue for $120 and credit sales taxes payable for $120 to correct it. But properly, it should be separated from the start.
Okay, that's clear. Collection agents for the government. What about income taxes payable? Another tax liability.
Yes, but this one applies mainly to corporations.
Why just corporations?
Because corporations are separate legal entities, and they pay income tax on their own profits. Proprietorships and partnerships, they're different. The owners report the business income on their personal tax returns, so the business itself doesn't record income taxes payable.
Ah, okay. Pass-through entities versus separate tax-paying entities.
Right, and another key point. The income tax expense and the resulting payable are based on taxable income calculated using the tax laws. That's not always the same as the accounting income calculated using GAAP, generally accepted accounting principles.
Oh, right. Book income versus tax income can differ.
They often do. So let's say Margot Company calculates its taxable income according to tax rules as $300,000. And let's assume their tax rate is 20%, they would record. Debit income tax expense for $60,000, 20% of $300K. And credit income taxes payable for $60,000. This liability represents the amount owed to the government for income taxes for that period.
And those differences between book and tax income, that sounds complicated.
It can be. It leads to things like deferred tax assets and liabilities, which is definitely a more advanced topic, maybe for another deep dive.
Okay, so we've hit the big payables. Accounts, notes, sales tax, income tax. But you mentioned a few others briefly earlier: unearned revenues, salaries payable, current portion of long-term debt. Can we quickly touch on those?
Sure thing. Let's start with unearned revenues, sometimes called deferred revenues. This happens when a company gets paid before they deliver the goods or services.
Like a magazine subscription paid up front. Or maybe airline tickets.
Perfect examples. The company has the cash, but they haven't earned the revenue yet because they still owe the customer the magazines or the flight. So that cash received creates a liability and obligation to provide the service or product later. It's usually current because it's expected within the next year.
Okay, liability until earned. Makes sense. What about salaries payable?
This one's pretty intuitive. It's wages or salaries that employees have earned by working, but that haven't actually been paid out by the end of the accounting period.
So if payday's the 5th, but the accounting period ends on the 31st, you'd have salaries payable for the days worked, but not yet paid.
Exactly. The company owes its employees for the work they've already done. It's a current liability. And the last one you mentioned, current portion of long-term debt.
Right. How does long-term debt become current?
Well, even if you have a long-term loan, like a 10-year note or a 30-year mortgage, some part of that principal is usually due to be repaid within the next 12 months. That specific portion, the principal payment scheduled for the upcoming year, needs to be reclassified from long-term debt to a current liability.
Ah, so you carve out the slice that's due soon.
Precisely. It gives a more accurate picture of the company's immediate repayment obligations. It's all about that liquidity picture again. And tying this all together, how do these show up on the balance sheet? Well, all these current liabilities are grouped together in one section. They're usually listed in order of liquidity or sometimes by size, but definitely separate from long-term liabilities. So you might see a presentation like this, just as an example. Current liabilities. You'd have accounts payable, say $50,000. Then maybe notes payable, $102,000. But wait, remember that discount.
Right, the contra liability.
So it'd show notes payable, $102,000, less the discount on notes payable, maybe $2,000 still remaining. So the net amount shown is $100,000. Then you'd list sales taxes payable, say $5,000, income taxes payable, $60,000, maybe salaries payable, unearned revenue, etc. And then you'd have a line for total current liabilities, which in this rough example adds up to, let's see, $215,000 plus any others.
Okay, so it provides a clear subtotal of everything due relatively soon.
Exactly. It's a critical number for anyone analyzing the company's short-term financial position, a real vital sign.
That's a great overview of how they're presented. But, sometimes things aren't so black and white, are they? When does something that might cost the company money in the future actually become a liability? What about uncertain situations?
That's a really important area. There are situations where determining if an obligation exists is challenging. A key principle is that anticipated future losses, just because you expect something bad might happen, don't automatically create a liability.
Why not, if you think you're going to lose money?
Because the event that creates the actual obligation hasn't happened yet. Remember, condition 3, it must result from a past event. So the Farhat material gives an example. Astra Inc. mentions they anticipate losses from some pending transactions, but because those transactions aren't finalized, the loss hasn't actually occurred. No present obligation exists yet, so no liabilities recorded on the balance sheet. It might be disclosed in the notes, but it's not a formal liability.
Okay, so expectation isn't enough. The trigger event has to have occurred.
Correct. And this comes up a lot with things like potential lawsuits.
Ah, yes, always a tricky area.
Definitely. Just because a company might get sued, or even is being sued, doesn't automatically mean a liability is recorded. You have to meet 2 criteria again. First, the potential loss must be probable, highly likely. And second, the event that caused the potential lawsuit must have already occurred before the balance sheet date.
So if Henlo Co. thinks they might be sued next year over something happening now, but no suit is filed and the outcome is uncertain.
Then generally, no liability is recorded yet. Again, it might warrant a disclosure in the financial statement notes explaining the situation, but until the loss becomes probable and stems from a past event, it doesn't meet the strict definition of a liability for balance sheet purposes.
It really highlights that careful distinction between a potential future issue and a genuine present obligation from the past.
It does. Accounting aims for reliability, and booking liabilities for mere possibilities wouldn't be reliable.
This has been incredibly insightful. So let's try and wrap this up for everyone listening. Key takeaways from our deep dive today. First, remember those 3 conditions for a liability. Probable future sacrifice, present obligation, past event. That's the bedrock. Second, current liabilities are those due within a year or the operating cycle. Super important for assessing liquidity. Third, payables like accounts payable, notes payable, taxes payable represent those specific, often contractual short-term debts. They're the immediate claims.
Right.
Fourth, that classification current versus long-term is critical. It really shapes the story the balance sheet tells about immediate financial health. And finally, you've got to be careful with uncertain situations. Potential losses or lawsuits only become liabilities under specific, quite strict conditions.
And maybe one final thought to leave you with. Now that you have a better handle on these principles, think about how it changes the way you look at a company's financial statements. You're not just scanning numbers anymore, are you? You can start to see the commitments, the pressures, the short-term story unfolding behind those figures. How might knowing this, really understanding what a company owes and when, affect how you assess its risk, or maybe spot an opportunity? It's not just for CPAs, you know. This understanding of liabilities gives you a much sharper lens for looking at the financial reality of any business, maybe even your own finances. It's about knowing the